Good evening, participants. Welcome to the first webinar in the new year 2025 on equity markets by UTI Mutual Fund. Before we begin, I would like to wish all the viewers a very happy new year. As you know, this is our monthly series where we delve into updates and outlooks on the global and domestic economic trends, equity market valuations, and share our insights, followed by an in-depth discussions on one of our fund's strategies. I am Sonal Mittal, product specialist at UTI Mutual Fund. I'm joined by our head of equity, Mr. Ajay Tyagi, and Mr. Karthikraj Lakshmanan, who manages UTI Large Cap Fund. Please post your questions on the link provided to you to make the most of this opportunity. Without further ado, I will now hand over to Ajay. Ajay, over to you. Thank you.
Thank you, Sonal, and welcome everyone to this webinar. Let me also start by wishing you and all your loved ones a blissful and prosperous 2025. As is customary, we will start this presentation by looking at a few data points that may be of interest to all of us on this call. So let's get straight into the first slide, which is basically showing us the breakup of GDP into two important vectors. One is private consumption expenditure, which is shown in the red bar, and the other is the gross fixed capital formation. You can also call it, the movement of capex in the country, which is shown in light blue. As you can see, over the last couple of quarters, we've seen an improvement in private consumption. At the same time, we have seen a deceleration in capex or gross fixed capital formation. All of us are aware of the fact that most governments around the country have become populist. There are more and more of these welfare schemes that are being rolled out by state governments. At the aggregate level, obviously, this is leading to a very big figure put together collectively, and therefore there will be an implication of this on overall consumption, a positive implication of this on overall consumption in the country. At the same time, what's also happening is that governments, because they also have to control their fiscal deficits, are actually looking at cutting down on capex over time. And that is going to have consequences on capex growth. So in a way, expect consumption trends to be stronger over the coming quarters and capex trends to be slightly weaker over the coming quarters. Yeah, next. We all keep talking about the valuations of the Indian market, whether markets are expensive, cheap, while we will go through some of these charts in terms of their, the usual charts around price earnings multiple for large caps, mid caps, and small caps. But we thought this time, let's also see what the valuations of India are in context of where we have been vis-a-vis our GDP or our proportion of global GDP. So the blue line here is basically India's share of global GDP. We are tracking this number from 2003, so almost 20 years of data. The red line is basically India's proportion of world market cap, again from the same time period. Whenever the red line jumps over the blue line, these are phases when the Indian markets become expensive in context of global markets. Whenever the red line slips below the blue line, these are phases when you can say that India is relatively cheap compared to the world markets. As you can clearly see on the right-hand side, the red line has once again jumped and crossed over the blue line to go above it, which is a sign that the Indian markets certainly are looking expensive compared to where the other global markets are. So this is just another data point, another way to establish the fact that are we cheap, are we fair valued, are we expensive? And this data point is clearly showing that yes, we are an expensive market today. Next. Let's go to the comparison of the few indices that we track over a 1 month, 3 month, and 1 year period. Starting with the 1 month period, over the last 1 month, mid and small cap have remained negative. They've done better than the broader markets. The worst performing index is Nifty Next 50, which is down by almost 4%. Over the same time period, amongst the sectoral indices, pharma has done very well. As you can see, it's up 5%. Real estate and IT are also positive. All other sectors are negative, with the worst performing sectors being actually metals and energy and media. From a 1 year perspective, Nifty Next 50 is still delivering very strong returns, and Nifty 50 has already slipped below the double digit. It is delivering 8.8% returns. Next. If you look at Indian markets versus some of the other global markets, firstly, over a 1 month period, we are somewhere in the middle, managing to give a positive return. The best performing market has been Japan. US has actually been under pressure, negative, and this has basically happened because there are expectations around future rate cuts being much more muted. We were expecting 4 rate cuts in calendar 2025. It now appears that maybe there would just be about 2 rate cuts. Over a 1 year period, though, India is still standing tall, very strong returns, and the worst performing market has been Brazil. Next. This is the earnings trend over the long term, over a 30-year period. Earnings growth for India has been very, very strong over the last 3 years, but we are taking a breather now. We started the year with expectations of around 13-14% EPS growth for the current financial year, which is FY25. But as of now, it appears that we could be just about 9% earnings growth. Next year, once again, we are starting with an assumption of around 13% earnings growth. And let's see how this pans out. We'll become more certain about this year's growth by the end of Q3 results. Yeah. If you go on to the next slide, this is basically how the consensus EPS has moved both for the current financial year FY25 and for the next year FY26. Starting from the left, like I said, we started the year with expectations of around 13%, but those expectations have now got moderated. We are expecting now the Nifty EPS to be around 1061. So there has been a slow and steady decline in consensus. Let's start with the large caps, Nifty 100. We've taken both price to book value as well as price to equity over here, starting from price to book value, slightly overvalued, as you can see, about 15% overvalued. The magnitude of overvaluation in large caps is actually the least. So while yes, even large caps may correct, but this is that part of the market where the magnitude of is relatively higher comfort in this part of the market. When we measure it in terms of price earnings multiple, a very similar story. The overvaluation is around 25%. So certainly not cheap, certainly in the expensive zone. But since everything is relative, especially in financial markets, relatively speaking, large is certainly looking much more reasonable compared to mid and small. The next slide that we'll show you would be on the mid-cap valuations, and charts certainly start to look extremely dangerous and frightening over here. They are clearly into uncharted territory. We have never seen valuations go this high in mid-caps. As you can see, there is 100% premium in terms of the current valuations versus their last almost 20-year averages. What we show you on the chart is data only since 2015. That's because of space constraints, but actually the average number is calculated over a almost 20-year period. So from that number, we are talking about 100% premium. Certainly not a comforting picture. Certainly a very frightening picture, I must say. And that's why we have been calling out now for some time that we need to be cautious around mid and small caps. The valuations here are just telling us very, very clearly that there would be disappointments over the next couple of years, and forget strong returns. Even if these stocks as a whole, the index as a whole gives a positive return, that itself would be, to my mind, a bit surprising. We move on to the last segment of the market, which is small caps. And the picture is not too different from mid caps. Here again, valuations are almost 100% premium, give or take. So not too different from mid caps. The only difference I would call out here is that, look, in case of mid caps, we basically feel that the business models are relatively better established compared to small caps. So while valuations are high in mid, almost in line with small, but at least from a business perspective, there is relatively more comfort in mid caps. Small caps, on the other hand, have a very high mortality, and to that extent as well, we should be more cautious on small vis-a-vis mid. Let's move on to the next slide, which is basically around valuations of equities as a whole compared to fixed income. You've seen this chart, every month we've been showing this. Whenever the blue line is basically in the compartment below, which is the compartment called favorable towards fixed income, it certainly means that it makes more sense to have relatively higher allocation to fixed income versus equities. Although our model right now, which we use in the Balanced Advantage Fund, is showing us an equal weight between equities and fixed income. So clearly, valuations, once again, using this particular metric, are not looking favorable and not looking favorable towards equities. Let's move on. So to sum it up, basically, like I mentioned, the Federal Reserve, although has cut rates by 25 basis points in their last meeting in December, but the commentary seems to be around a lesser number of rate cuts in calendar year 2025 than what we had expected a few months back. I would say that this is also a sign of US economy doing well. So to some extent, I would say not all bad news. The fact that interest rates may not come down hurriedly is also on account of strong consumer expenditure, relatively strong wage growth, relatively strong employment numbers. And that's not bad after all. But the only negative news is that maybe the rate cuts will come down more slowly compared to the expectations earlier. Like we mentioned, Nifty 50 consensus estimates have been pruned down for FY25, 9% for the current financial year, 13% for the next. We are cautious about both mid cap and small cap, and we are very, very clearly articulating that one needs to be watchful about the prospective returns from these segments. Asset allocation has to be front and center right now. We are advocating money to move into balanced advantage and multi-asset allocation funds. The other thing from a style perspective that we are clearly witnessing is the shift from value towards quality. That's something that we have seen over the last 6 months. But as we all are aware, and we've been showing these charts at different forums, typically these trends last a few years. We are still in the very early laps of this movement from value towards quality. Like we always say, investors should have a staggered approach towards investing. And at this juncture, it definitely makes more sense to have a large cap bias versus mid and small. So with this, I end my presentation here. A slight tweak in the format today. We will be taking questions around the economy right now before my colleague Karthik jumps in with his commentary around the UTI Large Cap Fund. Yeah, over to you, Sonal.
Thank you, Ajay, for sharing your insights. Let's begin with a couple of questions here now. The first question is, what is your perspective on the markets as the overall direction appears uncertain? Several factors seems to be weighing on the sentiment. There is downgrade on expectations from the earnings. FIIs appear hesitant to view India as an attractive opportunity, and markets are struggling to sustain higher levels. Considering the current market dynamics, where do you see the markets headed, and what factors do you think are influencing them at this stage?
So, Sonal, it's not very good news in terms of the direction of the market. First caveat with which I want to answer this question is that, look, none of us have a crystal ball. We are not soothsayers. So, none of us have this ability to tell what the markets would be over the next 3 months, 6 months, or 12 months. But yes, our best guess right now is that markets would be in a downward drift. markets ought to be correcting more before we start to see signs of strong prospective returns from the markets. We did see those charts, just a while back in terms of valuations. And the biggest disturbing factor from our perspective is basically the very heady valuation. So I would say economy is doing fine. We would have phases of slightly higher inflation, maybe on account of food prices, vegetable prices, maybe on account of certain weather patterns, but that's okay. I mean, none of these are structural. They solve themselves out within a few quarters time. So we're not worried from a economic growth perspective. The government has also been loosening its purse strings and spending money on welfare schemes, which means that consumption, private consumption, which had stalled in this country over the last many quarters, should also see a revival. There are early signs for that. So from that perspective, I don't want to call out anything which is negative. Certainly not structurally negative, but yes, valuations have to get more attractive. It could be a slightly more prolonged price correction plus time correction. So that's what our guess right now is. Yeah.
Thank you, Ajay. The next question is, now that all eyes are on the upcoming budget in the near term, which sectors do you think could receive a boost this time? Over the past 5 years, there has been a significant focus on infrastructure development. Do you expect this emphasis to continue, or could there be a greater shift towards supporting the consumption side?
Sure, that's a very interesting question, Sonal. I did allude to this fact that the government is directing its expenditure more towards uh, consumption by way of coming out with these welfare schemes. And the government, of course, has to cut down on something. So it is cutting down on its capex. Capex for the first 8 months has been terrible. It's been extremely muted. There would certainly be some catch up in the remainder of the year. But from a trend perspective, we feel that the government may pull down its spend on different infrastructure sectors, whether it's defense or it's railways or it's roadways. And of course, these welfare schemes at the aggregate level will put in money in the pockets of consumers at large, which at some stage should definitely pull up overall consumption. So I think from that perspective, from the next few quarters perspective, infrastructure related sectors appear to be weak. Consumption related sectors appear to be much more favorably placed. Yeah.
Yeah, thanks, Ajay. I will take one more questions with you. I understand that we have some time constraint here. At the start of the year, the narrative was that emerging markets were attractively valued. China was positioned as a comeback trade, and US market appeared overextended, with expectations of an eventual reversal. However, early trends suggest that US markets are still attracting a significant share of global capital, leading to outflows not just from India but from China as well. Why are emerging markets once again struggling to gain momentum at the start of the year?
So financial markets are always a relative game. They're never an absolute game. So long as the attractiveness from a relative basis is stacked in favor of the US, you will see flow of capital happening there. So let's look at the developed markets first. Very clearly, US is head and shoulders above all other developed markets. So therefore, money obviously is flowing from all other developed markets into the US. As far as emerging market allocation is concerned, I think from a structural basis, India stands very, very favorably placed to get a undue share of these emerging market flows. My own guess right now is that the valuations are so unattractive that many of these FIIs, while they like India from a structural basis, from a geopolitical perspective, from a perspective of how our governance system is and so on, and how our longer term vectors like our demographics are there, but possibly they just are you know uh, giving a pushback to this argument because of the valuations in front of them. So structural basis, money will continue to flow to India. I would say, while as of today, we are used to retail flows being very high and FII flows being very poor, I will not be surprised in the coming months and quarters as valuations become attractive. FII flows will start becoming more and more positive, and possibly retail flows, which are always backward looking, which are always driven by what the past returns have been, may actually weaken. So, not worried too much on India's salience in the overall global asset allocation. Yeah.
Thank you, Ajay, for your time and sharing all your insights and taking up the questions. I would like to now invite Mr. Karthikraj to share his insights on UTI Large Cap Fund. To give a brief introduction, Karthik had joined UTI in July 22 as a fund manager and now managing UTI Large Cap Fund and UTI MNC Fund. He is a CFA chartered, CA, and holds postgraduate degree in business management from SPJ IMR, having a work experience of over 20 years. Uh, Karthik, welcome to the webinar. And now I hand over to you for taking up the large cap fund strategy.
Thanks, Sonal. Good evening, everyone. Wish you all a very happy new year. As Sonal mentioned, I'll be discussing about the large cap fund, the strategy and why large cap. So if we move to the next slide, this is something that we've discussed in the past as well, just as a kind of a reminder. We're just trying to understand why large caps or what is the advantage of large caps. The first factor is that many of these large cap companies have been there for decades together, if not years. They've seen cycles, and to that extent, through the cycles, they have bettered their balance sheets, and their financial strength is far superior. Not necessarily that this is true to large caps only, but over the period of time, what we've seen is the degree of ability of companies to weather storm probably is higher in case of large caps compared to mid and small caps. So to that extent, the financial strength is a place where large caps clearly score as a category when we compare it with mid and small caps. Again, if we see the large cap companies, many of them could be leaders in their category or in some geographies or in some sub-segments. So they do have advantage of that leadership in terms of brand, in terms of scale, and in terms of the kind of offering that they have, whether it is in products or services. So that leadership advantage is something which is again positive for large caps. And then coming to economies of scale, compared to the smaller companies in that particular industry, the large companies would generally have a scale advantage, which could throw up operating leverage for them or economies of scale. All of this put together often creates that competitive advantage. And that is what we look at, especially when we are picking stocks for the UTI large cap fund. So the competitive advantage can be in terms of the brand, in terms of the distribution network that the company might have, or it could be just the cost of operations that has been achieved through economies of scale, and so on. So these are the competitive advantages which we look for. And why this competitive advantage is important is that through the cycles, these companies come out better in terms of ability to grow profitably, and the visibility of that growth is far higher in these companies with competitive advantage. If we go to the next slide, now we are talking about why large caps. So we showed this when we discussed few months back as well. What we are seeing is the rolling 5-year returns of Nifty 100, which is the large cap, compared with Nifty Mid Cap 150 or Nifty Small Cap 250. The gap is one of the widest. We've not seen this wide gap even in that 2017-18 phase. Like Ajay did highlight some time back in the chart, in the valuations and in the performance, the mid and small caps have clearly outperformed over the last 2-3 years, or even if we take the post-COVID period. And to that extent, the rolling returns gap between large caps and mid and small caps is one of the highest. So what we are saying is there is high likelihood there will be mean reversion here, and over the future period, the large cap performance should start to kind of do better than mid and small caps, so as to the narrowing this gap between the mids and the large caps. If we go to the next slide, Here we are showing the risk-adjusted returns. So if we take the rolling returns, rolling 5-year returns for probably the last 15 years, what we are seeing is that large caps generally represented by Nifty 100 have given a return of close to 12.2%. The number for mid caps is 15.3 and the number for the small caps is 12.5. But this is just the absolute number. We need to take risk into account. So that's where when we take a measure like standard deviation, we get a risk adjusted return. So on a risk adjusted return basis, clearly the large caps are comparable with mid caps. The 1.08 number that you see at the bottom is comparable with the 1.07 of mid caps and actually superior compared to the small caps, which is 0.58. What it means is that while the returns might be absolute returns might be comparable to a small cap 12.2 versus 12.5, there is a lot of volatility in small caps represented by the standard deviation of 8.7 compared to large caps which are less volatile at a 4.3%. So for an investor, when you look at the risk adjusted returns, that is through the cycles, the kind of drawdowns that you see is far lower in large caps compared to small caps, and to that extent the risk adjusted returns are actually superior in large caps compared to small caps, and in fact almost similar to mid caps. In here again, what we are showing is that over the last 14-year period, this is one of the lowest point as far as large caps representation in Nifty 500 is concerned. Lowest point as far as within the Nifty 500 pie is concerned. So again, we would expect some mean reversion here. If we go to this next slide, again, what we've been discussing is that the large companies over this period, again, the last 15 years, have become larger. So if we take across sectors, whether it is bank, credit, cement, steel, telecom, aviation, paints, pharma, life insurance, and so on, we've seen that over the periods, clearly the top companies, whether it's top 3, top 5, top 6, have actually gained market share. NBFCs, again, there has been M&A activity, so that's why the number looks different in FY24. But more or less across all these sectors, what we've seen is the large companies have become larger. Like we discussed in why large cap, the advantage could be quite different for different sectors. It could be distribution in case of paints, it could be see low cost providers in case of bank credit, it could be economies of scale in passenger vehicles and so on, different competitive advantages. But the fact remains that most of these sectors we have seen consolidation or the big getting bigger, and to that extent also there is case for many of the large companies to kind of outperform over a longer period of time from a revenue and profitability perspective, which eventually should reflect in the stock. Multi-baggers are companies with greater than 15% returns over 15% CAGR returns over these 10 years. So there, if you see, the large caps also are well represented in the multi-baggers. While mid and small caps, no doubt, 44 and 42% of them have been multi-baggers as of FY24, while only 37% of large caps have done. But it is not that you will find only multi-baggers in mid and small caps. Even in large caps, almost more than 1/3 of the large caps have delivered those kind of multi-bagger returns. So point being that while mid and small caps, because of their size, there is potential for them to create multi-baggers or create high compounding returns. Even some of the large caps have that potential, as we can see in those blue parts of these bars. If we go to the next chart, this is the reverse. What we are saying is the wealth eroders, that is over a period of 10 years, companies which have given negative stock price returns or are delisted for some reason. When we look at that part, the yellow line is yellow part is the small and mid caps, while the purple line is the large caps. Again, here the large caps wealth erosion is lower compared to mid and small caps. So when you're entering into mid and small caps, while the potential of higher returns remains, there is also risk of mortality or wealth erosion as well. So that's where the stock picking becomes all the more important in mid and small caps compared to large caps. Large caps, while they do have multi-baggers as well, on the wealth erosion, they're far lower compared to mid and small caps. Uh, if now, just when I say that over the last 4 or 5 years, the mid and small caps have outperformed significantly on stock price, and the gap with large caps is one of here because their margins have been improving and they've seen operating and financial leverage benefits. But the margin improvement can take you only so much. The core growth has to be the revenue growth, and there we don't see too much of a difference between large caps, mid caps, and small caps. Now, at a point when the margin expansion story is already behind or we are close to the peak, going forward, the weightlifting has to be done by the revenue growth itself, and that's where we believe large caps are well placed compared to mid and small caps. And if at all there is some margin erosion, or if the, like Ajay mentioned, if the environment is likely to be a little more tough in the next 1 or 2 years for the listed companies, then probably large caps actually stack up much better compared to the mid and small caps. Now, coming to UTI large cap, how we are different or how the positioning of UTI large cap fund is. Here we clearly follow growth at reasonable price. So what it means is we would have companies with high growth and high PE, but the high PE is or high valuations are justified by the growth potential those companies have. Or in some cases, we might have mediocre growth or low growth, but the valuations are reasonably attractive. So for the kind of growth that they have, we would have a commensurate valuation, and to that extent, it is growth at reasonable price. It's not a very high growth at very expensive valuations. It is a growth. The valuations are more justifying the growth that the companies have over a medium to long term. Also, the other factor that we look at is clearly the competitive franchise or moat, business moat, as it is commonly called as, which could be in terms of, like I mentioned, the brand of the business, if it is a consumer-facing business, or it could be in the nature of cost of operations or distribution, or it could be a network effect, the kind of customers that they have and the network effect that it is playing on, or it could be say technology from, especially in case of MNCs, where the parent brings in the technology at a very nominal rate, and many of these companies can leapfrog and benefit from the parent and its global sister concerns. So those are the advantages that we look at when we pick stocks within the large cap universe for our UTI large cap fund. Now, what this has helped us is, I mean, as we know, UTI Large Cap, earlier it used to be called as UTI Master Share, is one of the oldest funds in the category with close to 37 years plus history. What we've seen is in this period, over the, say, last 2 decades plus, we've had at least 7+ instances where the benchmark has corrected more than 20%. So the BSE 100 correction has been more than 20%. So whenever there have been such corrections, UTI Large Cap Fund has outperformed the benchmark because of this focus on high quality companies, focus on competitive advantage franchises. They hold good, especially in a environment where the markets are correcting at a rapid pace. Also, on the right-hand side, the last two columns show the subsequent returns if they were invested at the lowest point in the next 3 to 5 years, which is true for the markets and also holds true for the UTI large cap fund. That the subsequent 3 and 5 year returns have been quite good, anywhere from 50% to as high as 150+% kind of a return. So also a lesson for us is that whenever there is such drawdowns, eventually in the next 3 and 5 years, the market returns have been quite strong, and to that extent, one should stay invested. And if there is room for the individual investor in their asset allocation to add to exposure, equity exposure, they should do so, especially on such corrections. These are few examples for competitive franchise which we've been running for some time now. So this was a large private bank over the last 25 years. Their competitive advantage has been low cost of fund, so which has helped them continuously gain market share and grow profitably. When your cost of funds, the raw material for a bank is the cost of funds that it deposits itself is at a low cost, they don't really have to take excess risk, and to that extent they've been able to grow without taking excess risk, and that's why the credit costs have been under control, the profits have been uh, kind of high and more predictable, and that has helped them continuously gain market share. If we go to the next example, this was a case of turnaround, a similar large private bank with strong liabilities, but they had asset quality issues on the corporate lending side. As soon as that started to kind of come to an end, we started to see that this bank could also have the potential of low cost of funds and hence continue to grow profitably and gain market share. Clearly, so that's a turnaround that we've been able to catch. So in UTI large cap, like I said, I mean, the focus is on competitive advantage. And also, while we have companies on a growth side, we do have room for some turnaround and value opportunities as well. While there is a growth blend, clearly we do have opportunities identified in the turnaround cases as well as in case the value segment. So that's the positioning as far as UTI large cap is concerned. Now some more data on UTI large cap. So normally we run about 50-55 stocks. The tail has become a little longer now. We've added some stocks and it's close to 60 at this point in time. So I mean, we would look to have around stocks around these range, around 50 to 55 to 60 odd stocks at max. And in terms of exposure, we do have some exposure to mid and small caps as well. Normally, as per the regulation, we need to have at least 80% in large caps. At this point in time, we have 89. We do have anywhere between 10 to 15% in mid and small caps. These mid and small caps are also structural in nature. Many of these companies we intend to hold for years together. In fact, many of them we've held for multiple years, as long as the thesis plays out and the valuation is not too expensive. We are happy to hold many of these mid and small cap companies as well. So to that extent, we do take some exposure, but predominantly it is still a large cap fund. And the process, the score alpha method that we follow at UTI, based on that, we have a the tiering of the companies or the portfolio into C1, C2, C3 based on cash flows, and R1, R2, R3 based on ROC. So as you can see, we are focused on companies with operating cash flow, positive operating cash flows. So that's where it's 93% of the portfolio is in those companies with good operating cash flows. And on the ROC front as well, since it is growth blend, we have close to 2/3 of the portfolio in high ROC companies, that is R1, while we do have some exposure to some of the turnaround and value companies. So that's where we have about remaining 1/3 of the portfolio. So that's broadly the portfolio gist that I wanted to cover. If we go to the top holdings, you can see on the left-hand side, the top 15 holdings. If you see that its percentage of NAV, it max is 10%. So that's where we have the top holding around 9.78. And the last of the top 15 are at 1.94. So roughly about 2 to 10% is the weight for the top 15 companies. While we do have a longer tail, the top 10, top 15 or top 20 concentration still remains. Also, I would like to highlight, when you look at the active weight, that is the AW, the second column in the left-hand side table, most of them are positive, which means that wherever we have conviction, we have an overweight in those names. So to that extent, it is more concentrated at the top. It's not like, I mean, it's very too much diversified. At the top, we do have concentration, and at the bottom, we would have some tail. Right-hand side is all the unique stocks. Many of them would be mid and small caps. So many of them, like I said, we would be holding for multiple years. And the idea is these are companies which might eventually become large caps, or they might be growing faster in their categories. So from a sector positioning, at this point in time, we are overweight on IT. Last couple of years, we've been overweight on IT, and that is something which has started to kind of see pick up. The business momentum has started to kind of improve. We've also been overweight on consumer services within the consumer space, while we are underweight on FMCG and overweight on consumer services, because we believe the retail part, we believe the organized retail is likely to gain share and grow faster. And to that extent, we've had exposure there while we've been underweight on FMCG. Other than that, telecom is again something where we've seen consolidation in the industry in the last few years. There has been pricing discipline as well. The profitability has been increasing. So that's one other space where we've been overweight. In the last few months, we've cut down our underweights on oil and gas and FMCG to some extent, more on a bottom-up basis wherever the valuations have corrected and the valuations are more reasonable. We've kind of added in these two segments especially. If we go to the next slide, like I mentioned, this is the movement of our active weight. If you could see, we continue to be overweight on IT compared to the last discussion. We continue to be overweight on telecom. The financials, while we are more or less neutral, it's more stock specific where we would have taken some reduction there, but more or less neutral, especially on the private banks. Large private banks is a space where we are positive. Auto, while a couple of years back we were overweight, after the rally we've been more neutral at this point in time. FMCG, like I mentioned, we were underweight significantly. We've been cutting down our underweight there. And oil and gas as well, we've been cutting down our underweight. That's largely from my side. Sonal, back to you for questions.
Thank you, Karthik, for sharing the insights on UTI Large Cap Fund in such detail. I would request participants to keep posting their questions on the link provided, while I'll start with the questions that we have already received. Karthik, first question is, do you think the broader markets delivering an outperformance this year, will large caps take the spotlight given the ongoing FII selling?
Right. So three parts to the question. If we take the FI selling, I think Ajay did mention about that. I mean, at some point we would expect a reversal there, but it is very difficult for anyone to pinpoint when that happens. Flows is something that is far more driven by sentiment and multiple other factors. A lot of the FI holding in India is through by way of their exposure. I mean, emerging market funds having exposure in India as well. Very few is dedicated India funds where probably they may still continue to hold. So the flows, it might be very difficult for us to pinpoint when that turning around happens. So we would not hazard a guess there. The second part, large cap versus mid and small caps, I did highlight, and even Ajay mentioned in the valuations clearly at this point in time. While all three of them are expensive, on a relative basis, large caps actually look better than mid and small caps. Even the 6 months back when we presented on UTI large cap, we did mention that large caps, we expect them to outperform from here on. We've seen about close to a 10% drawdown in the last 3 months. September 24 is the peak in the market, and from there we've seen some drawdown. Even in this drawdown so far, we've not yet seen the large caps actually outperforming. They're more or less in line or slightly lower than the mid and small caps. So if at all the correction persists, actually, that's when we would see actually the UTI, the large cap as a category kind of starting to outperform the mid and small caps. So that way, we would say large caps are clearly better than mid and small caps. Coming to overall markets itself, I mean, again, Ajay did answer this. It is difficult for any of us to kind of pinpoint or say how the market will perform in the next 3, 6, or 12 months. But what we see incrementally is that the earnings growth is slowing down. The markets have significantly moved up in the last 4 or 5 years, and to that extent, the valuation comfort is not there. While from an economy perspective, there is not too much of issue. I mean, economy seems to be quite fine. The problem is the markets may have run up a little higher than the fundamentals, and to that extent, one needs to be extra cautious. It could be a time where caution would be much better, especially after a stellar 4 year period of market returns. So it's difficult to say how the markets will perform, but it's time probably that investors exercise more caution while investing in equities.
Thank you. The next question is, since everything comes down to earnings, which are the segments do you believe might outperform in terms of earnings growth? Which ones are likely to lead earnings growth and can deliver above average returns?
Right. Yeah, I mean, clearly, like you mentioned, at the end of the day, from a medium to long term, earnings growth drive the stock prices. In the short term, it could look like sentiment flows and all of this. Eventually, for a company, a portfolio, or an index, the overall earnings growth is important. But only difference is, I mean, when we are looking at in the short term, especially where we are sitting at this point in time, we've seen excess returns in many of the pockets over the last 2, 3 years. And to that extent, even though they may be having strong earnings, probably the markets may not have factored in more than what is the potential for those companies. So even a high growth companies may tend to underperform if the market expectation is X and their delivery is likely to be X minus 5 or X minus 10. So even in high growth companies, one needs to be cautious of the valuations that they are paying, especially at this point in time. Whereas the reverse could also be true. Some of the mid-growth companies may have seen so much of underperformance on a relative basis, they could still be attractive. So that's where at this juncture, we believe that it's probably wise to look at both earnings and their valuation versus their historical valuations. So just earnings may not give the answer. You'll have to look at earnings as well as their valuations compared to their 5 year or 10 year average valuations. And based on that, like I mentioned, private banks within financials still continue to be not too expensive. Their runway for growth still continues to be very high from a 5, 10 year perspective. They will continue to gain market share. And companies typically who are gaining market share and doing that profitably so eventually create wealth for shareholders. So that is one space that we would look at from a longer term perspective. And select pockets of consumer after a significant period of underperformance, the valuations are no more excess, and to that extent there could be opportunities on that side as well. So that is one pocket. That telecom, like I mentioned, is something that we believe will continue to have good profit compounding. And IT is a sector where now we are seeing the outlook improving. We've seen the rupee has been having a stellar run, but in the recent past we've seen some depreciation of rupee as well. So from positioning wise, exporters may be a little better off at this point in time, and to that extent, IT as a segment also stands out. While the valuations are not too cheap, especially after the outperformance in the last year or so, still they are not too expensive compared to the kind of cash flows and the ROCs that they provide. And when we compare that with some other sectors within the Indian markets.
Thank you, Karthik. The next question is somewhat related. Could you share which segments you have increased your positions? What is your current cash level? Are you fully deployed or have you recently ramped up your deployment?
Right. So first on the second part of the question, as far as cash levels are concerned, at UTI generally we don't really take a cash call. So we would not have more than 3 to 5% cash in most of our equity funds across time frames. So it's not a question of whether we are deploying or increasing cash. More or less the average is in that ballpark around 3 to 5 odd %. So there's no major change in that. Now what sectors that we have increased, as I mentioned, from a UTI large cap fund perspective, we've reduced our underweight in FMCG as we believe the valuations there seem to be less expensive for the lower growth that they have. And while we still continue to be underweight, we've definitely reduced that underweight and we've added to some weight there. And we've taken profits in auto, like I mentioned, while we are still neutral, but we used to be overweight. From there, we've taken some profit. And again, IT, when we take a longer term, say 1 2 years, we've reduced the IT exposure. We still continue to be overweight, but we've taken off some profit there. On the other hand, energy is something where we've been underweight, but more on a bottom-up basis, we've found some companies which are attractive, and they're attractive on a valuation perspective and cash flows perspective. So that's where we've increased exposure there.
Sure, fair enough, Karthik. Next question is, why is private capex spending not taking momentum yet?
Right. Clearly, government capex, the central government capex over the last 4 5 years has been quite strong, and that has been driving overall revival in the investment cycle. Private sector, when we look at the cash flows over the last 3 4 years has been quite healthy, but the capacity utilization overall, the number that RBI provides is just about reaching that 70% 75%, where we start to see a lot of capex happening. On a sector basis, we have seen a lot of capital commitment in the power renewable side, metal side, and so on. But at the aggregate level, yes, I mean the private capex is yet to pick up fully because the existing capacity needs to be utilized, and we should see a gradual recovery there. Also, just to add to that, compared to say 2003 to 10 or 12 kind of a cycle, this might be different because here we're not seeing huge capex recovery as far as private sector is concerned. It is likely to be far more measured. We don't really expect at that point in time. If you remember, there was telecom infrastructure, metals, power, all of them committing huge capital. Now, a lot of that is already in the base. Many of these companies are already sizable. So the growth on this base may not be as high as what we would have witnessed in that phase. It will be far more gradual, and we expect that to kind of slowly ramp up. While the government capex is something that is continued so far, except for FY25, which Ajay did highlight about, but we expect the capex cycle to continue.
Sure. So, Karthik, there are funds in the passive space running a rule based strategy, and then there are actively managed large cap strategies. So,
Right.
do you anticipate a greater shift of investors towards passive strategies in specifically to large cap?
Right. So we've seen the phase where large cap funds have, as a category, not been able to beat the benchmark, and that's where this question keeps coming up. But our answer is that clearly, while it might be tougher, there is still a lot of opportunity for active funds to kind of generate alpha versus the benchmark by way of stock picking within the top 100 companies, which is large caps. Also, selecting some of the mid and small cap companies, like I mentioned, there is room of up to 20% for the large cap funds to have mid and small caps. So if you can identify mid and small caps which can grow faster or eventually become large caps, that is one more additional source of alpha that can be created. In a country like India, we are still seeing lot of segments which are growing. I mean, organized retail for one is still growing and will be represented more in the listed companies. So those sectoral dynamics will also keep changing. The top 100 companies composition will also keep changing. That also provides opportunity for the large cap funds to create alpha. So we definitely believe there is room for active funds to create alpha. There have been times when the passive fund, returns have been lower than the benchmark, but we believe that as the economy's outlook is quite strong, and we believe there'll be a lot more leaders and leadership changes within the top 100 companies, the opportunities are good enough for alpha creation.
Sure, Karthik, in the interest of time, I will take one more questions.
Right.
We would like to understand how do you pick stocks, because the universe is limited, top 100 companies by way of free float as defined by the regulators. So what is your strategy for picking stocks?
Right. So at UTI Large Cap, like I mentioned, the first point is clearly focus on competitive advantage. We look at companies which have that competitive advantage within the top 100 companies, and the remaining companies also, wherever we have exposure, like I said, close to 10 to 15% exposure in mid and small cap companies. The filtering is the same. I mean, we look for these competitive advantages. They might be leaders in their segment, or they may have a cost advantage. They might be growing faster or gaining market share. So those are the companies that we look at. And uh, so the idea is to have valuations also as a parameter, because it's growth at reasonable price. So while the company might be very good on competitive advantage, but if the valuations are not really justifying that, that may be a reason why we may reduce exposure in those names, or even avoid those names or sell out those names. Where, like I just answered in the previous question, from a mid and small cap perspective, companies where we believe the growth can be higher or which can be future large caps is something that we look at, and we would look at it from the same eye and with the same thought process of buying and holding on to them as long as the thesis plays out. And obviously, unless the valuations move up very significantly for us to justify that, we would ideally want to have exposure there as well. Just to kind of summarize, in the top 100, we need to have 80%. So we'll have probably about 40, 45 names out of those 100 companies. So we need to select only 40, 45, or at max 50 from that 100. And again, we need to be having at least a 10, 15 names from the remaining 400 odd companies if we take that as the benchmark, the remaining mid and small cap companies. So there is enough room. So that's the thought process. The competitive advantage is the first filter, and growth at reasonable price is the second filter.
Thank you so much, Karthik. On behalf of UTI Mutual Fund, I extend our sincere gratitude to all the viewers for participating today and asking questions. We believe that today's session provided you with enriching insights, offering a comprehensive update on equity markets and a deeper understanding of UTI Large Cap Fund. We hope that your queries have been answered to your satisfaction. Please do share your feedback on the link provided. Special thanks to esteemed speakers, Mr. Ajay Tyagi and Mr. Karthikraj, for sharing valuable insights and addressing the questions. As we conclude, we encourage you to stay connected with us for the future events and updates. Thank you and good day.
Thank you. Thanks, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.